Hi. How should you invest among the sell-off caused by the coronavirus? My name is Gary Mishuris. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So we're in the middle of a pretty big sell-off. There's news all the time. You can be glued to your TV or your stock screen or whatever it is, and fall apart as an investor. Essentially, stop doing what you said you're going to do. And what use is an investment process if you only follow it when everything is calm? It's like having I don't know, a life jacket on a boat that only works when the boat is fine, the sea is steady, and there are no waves. You want it to work when there are rough seas out there, right? So how do you actually do that? I think no, there are five things you can do to keep yourself and in the even keel, prevent yourself from going off tilt, and just sticking to your process. The first thing is to maintain your normal healthy routines. So what are some of those? So for many of you, including myself, it's going to the gym. Other people have meditation. I personally am into bonsai. These are little Japanese trees in the pot. Oh, not Japanese, but the kind of Japanese art of creating miniature trees and pots. And for me, it's very relaxing. It's almost like a meditation because I can spend 3 hours with a tree trying to wire branches or prune it or repot it or whatever it is. And that helps me focus on something within my control that I enjoy, that brings me back to nature, which I also enjoy. And I'll tell you this, during a day when the markets were down 70%, I did what I need to do. I put some buy orders in, and I went and I made a little pine bonsai. And you know what? That's perfectly fine. I would not have been more productive if I stayed in front of a computer screen and watched the stock prices go back and forth. That's not productive. That's just stressing yourself out. So stick to your routines, whatever they are. It doesn't obviously have to be bonsai for you. That's number one. Then the second point is, stick to your investment process, right? Your investment process is there for a reason. So don't decide that it doesn't apply because we're in a crisis. It is exactly there for a crisis. It's there for every other scenario as well, but exactly in a situation like this that you need the most. So stick to your process. Whatever it says, you should do it. Don't use the excuse that this is different or that you need to evolve your process. Evolving your process is fine, but you should do it when things are calm and you can be calm and deliberative, not in the middle of a situation like this. Right now, it's time to stick to your current process. You can make it even better next time. It'll be fine. So I think the third thing you want to do is to make sure you can never be a forced seller. So what does it mean to be a forced seller? Maybe you're levering a portfolio and buying stocks on the margins. You stocks can go way lower than you can even imagine, and you can have your investments literally taken away from you. So don't do that. That's a great way to go broke, even though it seems like you just amplifying your returns. Maybe, but maybe you just gonna go broke. So don't do that to yourself. Other ways you can be a forced seller is, let's say you're managing money for others and they have their own clients and they panic and take all your money away. Well, that's a problem. Or let's say you're managing money for your own family, but you haven't planned for cash needs and you were kind of planning on taking, cash for your expenses from your stock or investing account. Bad idea. You should have a separate pile of money for your expenses for some number of years so that the money investing in the stock market can truly have a multi-year time horizon. So, if you're not a forced seller, then you can only be advantaged by market's irrationality, right? So if the market's, quoting prices that you think are crazy, great, act on that in a way that's positive for you, but you can never be forced to do something against your will and sell at those prices. And that's the reason not to be a forced seller. So that's the third thing. The fourth thing is communicate, not just communicate, over communicate. So no, if you're managing other people's money, be visible, explain to people how you're doing, reassure them, hey, I'm doing what I said I was going to do, and we agreed that that was a good plan, and it's still a good plan, and I'm doing that. I just wanted to let you know. If you're managing your own money, but most people have others in their lives, whether it's their spouse or their family, communicating to them. Maybe your spouse isn't all that interested in the details, but you can still communicate because it forces you to let someone know that, hey, you know what, we had a plan, I'm sticking to that plan, I'm doing what we agreed. And if it's just you, just or explain to yourself in writing what you're doing. Like, why are you buying this stock, or why are you buying this mutual fund, or why are you selling, or what when you're forced to communicate, it clarifies your thoughts and it makes it more apparent. Are you being just irrational and acting based on your behavioral biases and panicking, or are you rationally following your pre-existing process? And the last thing is act, but slowly and deliberately. I think that there are two. I have a special, separate video on this. But you can make one of two mistakes. You can, be afraid to act and keep waiting for lower and lower prices and be mesmerized by falling prices. And let's say they never come. And by the way, there's a whole range of outcomes from this is going to be fine in 3 to 6 months, this all goes away, to this causes a multi-year recession. That's kind of the range. And right, if you're focused on just one scenario, let's say stocks go down 20-30% from here, and you're saying, oh my gosh, everything is horrible, and you fail to act, and it turns out that we're in a pretty benign scenario, you'll kick yourself, because you'll have watched unbelievable bargains in front of you, as one of my old bosses used to call it, watching the tennis game, watching the ball go, from here to there, from here to there, but not actually acting. Right? So don't do that. On the other hand, stocks can go way lower than you think and then go down some more. So, you don't want to go kind of all in and use up all your dry powder on day one. And as soon as you see a cheap stock or a cheap investment, buy a little bit if it follows your process. Then if it gets even cheaper, buy some more. If it's cheaper still, buy some more. Now, to wrap up, what if you're just a normal person? You don't buy stocks. You don't even buy actively managed mutual funds, which, by the way, is totally fine for most of you guys. You shouldn't be, trading in stocks or even buying an active mutual fund, because you can't tell, skill from luck in the manager, or you can't tell, who's a slick marketer versus who is actually, a thoughtful, investor with a good process. So maybe you are using a passive approach, low cost indexing, and let's say you had decided you were going to dollar cost average. Well, just do that. This is a perfect time to dollar cost average. The last thing you want to do is say, well, I'm going to buy low cost index funds when S&P is at 3,000, but not when it's at 2,300 or 1,900 or whatever the number is. Don't do that. Let's say you said, I'm going to put 5% of my salary into index fund every month or every quarter. Keep doing that. Now, keep doing that at any price, because your strategy is dollar cost averaging, and the only way the strategy fails is if you get scared and stop executing that strategy when prices are low. Now is the time, as if there is ever a time, to stick to that strategy, because there are certainly distressed prices out there, and there might be even more distressed prices in a week. So you want to consistently take advantage of those prices, and deliberately but slowly. So those are the 5 things. So stick to your normal routines, stick to your investment process. Those are the first 2. Make sure you can never be a forced seller. That's number 3. Communicate. That's number 4. And then act slowly but deliberately. That's number 5. If you guys like this video, please hit like and subscribe to my YouTube channel. Thank you.